Financial risk is an inherent part of any entrepreneurial venture. The moment a business begins to operate, whether at a micro or macro scale, it encounters financial uncertainties that can either break or build the enterprise. These uncertainties range from volatile markets, unexpected expenditures, unfavorable exchange rates, poor investment decisions, lack of credit access, to inadequate cash flow planning. Module 9 is dedicated to exploring the nature of financial risk, techniques for identifying and analyzing financial threats, methods of controlling and mitigating these risks, and strategies for building long-term financial resilience in business. By the end of this module, you will be able to 1. Understand the types and sources of financial risk. 2. Analyze financial risk exposures in entrepreneurial ventures. 3. Apply practical strategies to minimize financial losses. 4. Build financial buffers and contingency plans. 5. Leverage tools for proactive financial planning and forecasting. What is financial risk? Financial risk refers to the possibility of losing money or value in an investment, business operation, or financial transaction. For entrepreneurs, it represents the uncertainty about future financial performance, such as whether the business will be profitable, whether loans can be repaid, whether cash flow will remain stable, whether unforeseen events will cause significant financial strain. The dynamic nature of business means that financial risk is a continuous reality, and learning how to manage it is a survival skill for entrepreneurs. Categories of financial risk. Understanding the different types of financial risk is foundational. Major categories include A. Credit risk, the risk that a borrower will default on repayment. This is crucial for entrepreneurs who extend credit or rely on client payments. B. Liquidity risk, the risk that the business won't have enough liquid cash to meet short-term obligations, even if it's profitable on paper. C. Market risk, the risk of losses due to unfavorable movements in market variables, such as interest rates, inflation, or foreign exchange rates. D. Operational risk, the risk of loss resulting from inadequate or failed internal processes, systems, or external events. E. Legal and compliance risk, the financial implications of lawsuits, penalties, or regulatory breaches. F. Strategic risk, the financial loss resulting from poor business decisions, inaccurate forecasting, or entering the wrong market at the wrong time. Sources of financial risk in entrepreneurship. Entrepreneurs face unique risk sources due to the early and uncertain nature of their ventures. These include limited access to credit facilities or investors, overdependence on one or two clients, poor bookkeeping or financial illiteracy, cost overruns in product development, currency fluctuations, especially for import-export businesses, lack of business insurance, mismanagement of tax and regulatory responsibilities, unverified financial assumptions in the business plan. Identifying and measuring financial risk. Before managing a risk, it must be identified, quantified, and understood. Methods include 1. Financial ratio. Analysis. Using liquidity, profitability, and leverage ratios to assess financial health. 2. Cash flow. Forecasting, predicting inflows and outflows to avoid insolvency. 3. Break-even analysis. Calculating the minimum performance needed to avoid loss. 4. Sensitivity analysis, exploring how changes in variables, like interest rates or prices, affect profitability. 5. Scenario planning, creating what-if scenarios to stress test the business. Strategies for financial risk management. To combat these risks, entrepreneurs must build resilience mechanisms, including A. Diversification. Avoid relying on a single revenue source, customer, or market. Spread risk across different streams. B. Cash flow management. Monitor cash inflows, outflows daily or weekly, not monthly. Keep reserves for 3 to 6 months of operating expenses. C. Budgeting and forecasting. Set realistic revenue and cost budgets. Review variances regularly and adjust spending accordingly. D. Insurance coverage. Ensure the business is covered for theft, fire, liability, employee injuries, and natural disasters. E. Emergency funds. Build a war chest for economic downturns or unexpected business interruptions. F. Use of technology. Implement accounting software for real-time monitoring and financial analytics. G. Good financial records and tax compliance. Poor record keeping is a silent killer. Keep up-to-date statements, receipts, invoices, and ensure tax obligations are fulfilled. Financial risk governance. Even small businesses need to embed financial risk governance, that is, clear policies, controls, and roles to oversee risk. Elements include internal audits, regular financial reviews, risk registers or dashboards, segregation of duties to prevent fraud, decision-making protocols for major expenses. Case study, financial risk gone wrong. Case, a fast-growing fashion brand. A Nigerian fashion brand expanded quickly with multiple stores. However, it didn't forecast seasonal cash flow needs. Sales dropped during the rainy season, staff salaries were delayed, and rent bounced. The brand had no emergency fund and eventually closed. Lessons. Growth without cash flow planning and financial risk mitigation is a recipe for collapse. Resilience through financial literacy. Entrepreneurs must continuously improve financial literacy. Understanding 1. Income statements. 2. Balance sheets. 3. Cash flow statements. 4. Profit margins. 5. Return on investment. 6. Debt versus equity financing. 7. Break-even points. This knowledge allows proactive, not reactive, risk-taking. Building financial resilience over time. True financial resilience is built over time by reinforcing cost discipline, maintaining lean operations, building relationships with financial institutions, improving profit margins without compromising value, tracking KPIs, key performance indicators, scaling cautiously with risk buffers. Final reflection. Financial risk cannot be eliminated, but it can be understood, prepared for, and managed smartly. An entrepreneur who ignores financial risk is gambling. One who manages it with insight is strategizing for sustainable success. Financial risk management is not a one-time event. It is a lifelong leadership discipline that underpins business survival and growth.